But if the consumer ends up getting sapped because of higher gasoline prices at the pump, on top of that, you have less availability because of the private credit issues in consumer loans. You can actually squeeze consumers from both sides, squeeze them on the availability of credit and squeeze them on expenses. It's basically a recessionary setup, which is obviously bearish. Now, during oil shocks, UBS also tells us that during the last two major oil shocks, actually after each supply shock from the 1970s to early 1990s, the US economy went into recession. So basically after every shock from the early 70s to the 90s, every shock we had, we ended up having a recession. This is, offset by the Russia-Ukraine conflict where, we had inflation like 9.1%, and we didn't end up going into recession, though we did have quite a heck of a beating in the stock market. They also argued that historically during these oil crises, the S&P 500 ended up dropping a maximum of about 15%, but the S&P 500 is valued about 50% higher on a forward price to earnings multiple right now. Going into this shock today,